I'm about to share a life-changing lesson I wish I knew years ago. Investing mistakes beginners make. 1. Waiting too long to start. Many beginners think they need a lot of money, perfect timing, or deep knowledge. But the biggest mistake is not starting at all. Time in the market matters more than anything. 2. Trying to time the market. Beginners often try to guess the perfect moment to buy, the perfect moment to sell. Even professionals can't do this consistently. Timing the market usually leads to buying high and selling low. 3. Putting all their money into one stock. This is one of the riskiest moves. If that one company struggles, your whole investment suffers. Diversification protects you. 4. Investing without a plan. Jumping in because a friend recommended something, social media hyped a stock, it sounds good, usually leads to confusion and regret. A simple plan beats random decisions every time. 5. Ignoring fees. Some investments have high management fees, trading fees, hidden costs. Even small fees can eat into long-term returns. 6. Selling too quickly when the market drops. Beginners often panic when prices fall, but dips are normal. They're part of investing. Selling out of fear locks in losses. 7. Expecting fast results. Investing is not a get-rich-quick strategy. It's slow, steady, and powerful over time. Impatience leads to bad decisions. Not understanding what they're investing in, buying something you don't understand, crypto, options, complex funds, can be dangerous. If you can't explain it simply, you probably shouldn't buy it yet. Checking their portfolio every day, this creates stress and emotional decisions. Long-term investors check occasionally, not constantly. 10. Not taking advantage of index funds or ETFs. Many beginners think they must pick individual stocks, but broad funds are often safer, easier, and better for long-term growth. Most investing mistakes come from fear, impatience, or trying to do too much too fast. Start simple, stay consistent, and let time do the heavy lifting. How to invest with little money. You don't need thousands of dollars to start investing. Modern tools make it possible to begin with $5, $20, or even spare change and still build real wealth over time. Even small amounts grow thanks to compound interest, the same principle highlighted in beginner guides that show how investing tiny amounts consistently can lead to long-term growth. 1. Start with fractional shares. You no longer need to buy a full share of expensive companies. Fractional shares let you buy a slice of a stock based on the dollar amount you have. If a stock costs $100 and you have $10, you can buy 0.1 shares. This makes every dollar work for you immediately. 2. Use zero-commission brokerages. High fees used to make small dollar investing difficult. Now, many brokerages offer $0 trading fees, no account minimums, fractional shares. This means beginners can invest small amounts without losing money to commissions. 3. Try micro-investing apps. Apps like Acorns and Robinhood allow you to invest, spare change, automate small deposits, buy fractional shares, track your progress easily. Micro-investing apps are designed specifically for people starting with small amounts. 4. Start with index funds or ETFs. Index funds and ETFs are great for beginners because they are low cost, are diversified, track the overall market, grow steadily over time. Even small contributions to an S&P 500 index fund can grow significantly over decades. You don't need a lot of money to start investing, you just need consistency. Small amounts grow into big amounts when you start early. Invest regularly. Keep fees low. Use diversified investments. The barrier to entry has never been lower, and the long-term benefits are huge. Dollar cost averaging, DCA. Dollar cost averaging is an investing strategy where you put in the same amount of money on a regular schedule, no matter what the market is doing. It could be $10 every week, $50 every payday, $100 every month. The key is consistency, not timing. Why it works. The market goes up and down, sometimes wildly. DCA helps you avoid the stress of trying to guess the perfect moment to invest. Here's what happens when you invest the same amount regularly. Simple example. Imagine you invest $100 every month into the same fund. Month 1, price is $10. You buy 10 shares. Month 2, price drops to $5. You buy 20 shares. Month 3, price rises to $8. You buy 12.5 shares. You didn't have to predict anything. You just kept investing, and you ended up buying more when it was cheap and less when it was expensive. That's the magic of most people use DCA automatically through retirement accounts, automatic transfers, recurring investments in ETFs or index funds. Dollar cost averaging is a simple, stress-free way to grow your money over time. You invest a little at a time, consistently, and let the market do what it does. It's one of the easiest ways to build wealth, especially when you're just getting started. Long-term versus short-term investing. Long-term and short-term investing are like two different journeys. One is a slow, steady hike up a mountain. The other is a quick sprint across a field. Both have a purpose, but they work very differently. Long-term investing. Time frame: 5 years, 10 years, 20 years or more. Goal: grow wealth slowly and steadily over time. How it works. You invest money and let it grow through compound interest, market growth, reinvested dividends. You don't worry about daily ups and downs because you're playing the long game. Best for retirement, building generational wealth, college savings, anyone who wants stable, predictable growth. Common long-term investments: index funds, ETFs, retirement accounts, 401k, IRA, blue chip stocks. Example: you invest $100 a month into an S&P 500 index fund for 20 years. Even with market ups and downs, historically the market has trended upward over long periods. Your money grows because of time plus consistency plus compounding. Short-term investing. Time frame: a few days to 3 years. Goal: make quick gains or save for something soon. How it works. You buy investments you expect to rise in the near future. This strategy requires more attention and carries more risk. Best for saving for a car, saving for a wedding, saving for a house down payment. Investors who can handle more volatility. Common short-term investments: high-yield savings accounts, short-term bonds, money market funds, certificates of deposit, CDs. Short-term stock trades, higher risk. Example: you're saving for a house and need the money in 2 years. You put your savings into a high-yield savings account or short-term bond fund so it grows a little but stays safe. You avoid stocks because the market could drop right when you need the money. The big difference: long-term investing, slow, steady growth, less stress, uses time and compounding, great for building wealth. Short-term investing, quick access to money, lower growth, must avoid high-risk investments, great for near-future goals. Takeaway: use long-term investing to build wealth. Use short-term investing to protect money you'll need soon. The magic happens when you know which strategy matches your goal. Thanks for watching. Don't forget to like, subscribe, and share if you learned anything from this video.